But it would be good to get any key points out that people would like to share. So particularly around, any additional comments or really things that you want to share on the financial reporting challenges, and also any thoughts that you have on the poll responses. Was there anything there that surprised you in any way, shape or form, or is that pretty much as you would have expected?
Okay, thanks. Yeah, sorry, I couldn't unmute. Yes, I guess in my situation, we are applying IFRS 15 in a not-for-profit environment. So we have got some additional guidance in sort of explaining what a customer is and a contract is for IFRS 15. So our biggest problem is still matching. So IFRS 15 has not solved the problem with performance obligations. And I think I put in there that I think the International Public Sector Accounting Standards Board approach with their present obligation is a better approach. I don't think it solves the problem in trying to work out restrictions and conditions, but the general approach they had of, if you've got money to spend on specific projects or allowable expenditure, and essentially if you don't spend the money on what you're supposed to do, you've got to give the money back. That to me gets you to a sort of like a liability and starts to get into a closer matching of things.
Yeah.
And we have a lot of problems with capital grants.
Yeah.
In arrears, in advance. Some of those capital grants are very poorly worded. So one of the references was to IFRS for SMEs, and that talks about, well, when you get relieved from your obligation for any refund, you get to recognise the revenue. But if the grant is poorly worded to say, if you don't use the capital asset like the school building for the life, you have to return all the money, then that's a problem. Not all grant agreements are written with a sort of like a time value declining, because it's always assumed you'll use the building as you promised you.
Absolutely. No. Some really good points there, which I think we'll probably come back to. I think, thank you very much for that, David, that contribution. I think Pesh is trying to come in, but can't unmute himself. Perhaps whilst we're trying to resolve that, are you in, Pesh?
Oh, I don't know. Can you hear me?
You are. I can hear you.
Excellent. Thank you. The issue for me on restrictions, and there was quite a lot of confusion about this over the years, is this idea that if you have to return the money, if you don't spend it, you shouldn't recognize it. Seems to me somewhat challenging, because almost every grant agreement that I have seen says that if you don't spend the money, you have to return it. So the basis that we've been using with in the UK is simply what's in the financial reporting standards and in FRS is that you work on what you expect. If you expect to be able to meet the restriction, then you would recognize the income. If for some reason you are unable to meet the restriction, then you would defer the income and create a liability. So if, for example, you had to pull out of a country, if you had a geographical restriction to work in South Sudan and you had to pull out of South Sudan, and you therefore that meant you were going to return the income, then you would recognize it as a liability. But simply because there was a clause in the grant agreement that says you might have to return the income if you don't spend it, wouldn't be sufficient to defer the recognition.
Yeah, I think there is also kind of linked to that the situation where if you're dealing with the same donor repeatedly, and the custom and practice is that even though they say they want the money back, they don't ever ask for the money back. You gets into judgments in terms of substance over form if they just kind of say, well, I know we said that, but keep it anyway. So this can be kind of really kind of complicated.
But Karen, isn't that quite normal in any accounting judgment? You would have to take a call to see whether that income is likely to stay with you, or there's likely to be economic benefit passed back to the donor. And only if you think that that's likely to happen, the same way as a bad debt provision or something of that kind, only then would you work on that basis. You wouldn't just go by what's in the document.
No, absolutely. Substance over form is, sort of a recognised approach to this, as you say, and it needs to kind of feed into these kinds of issues as well. Pesh, thank you for that. I think Nishit wanted to come in.
Yes, thank you so much. I have 4 items with which we've had issues in the past. One is that, we are a behavior change, an organization that uses social and behavior change communication methods to enhance the value interventions. So when we do a program, for example, an anti-littering program, you would do it across many hundred schools. You would then, from the budget allotted to us, we would, develop materials like T-shirts, for example, for school children, or metal pins that school children will wear relating to the message on anti-littering. Now, the issue is that when we estimate the number of these items required, inevitably, there'll be some left over at the end of the program. So how does one account for this leftover items or inventory of material used for one campaign? The grant agreements don't have any kind of comments mentioned on this. Yeah. So suppose, for example, we were to say, let us sell it as junk for people who recycle the material, then how does one account for it? So that's one issue. The other is about asset ownership. Asset ownership is a very tricky thing. If a grant comes to us and part of that grant allows us to buy laptops for people who are on the field, for example, then the ownership of the laptop is an issue. This is always an issue about who will claim depreciation on the ownership. Now, the recent Foreign Contribution Regulation Act amendment in India says that if a foreign donor donates money to an Indian non-profit organization, then that asset will eventually vest with the government. Now, this is a big issue for everybody here. I mean, that asset could be it could be an ambulance, it could be computers, it could be a variety of things. So there's no clarity on how to handle that. There are other things, there are 2 other issues. One is about during disaster. Recently, we had the second wave of pandemic in India, the first wave last year, and lots of migrant labor returned from major cities across the country back to their homes. Many of them had difficulty transport, food, day-to-day shelters. So there was lots of contribution that came in from the general public, used clothes, used blankets, food parcels, and so on. Accounting for these and also accounting for the beneficiaries, because they're handed out on highways, they're handed out at railway stations. Getting details about the beneficiary with even an identification paper is very, very difficult.
Yeah.
Therefore, that's a real issue. Lastly, one simple item: when used items are donated, a used computer, a furniture that has been used in a company and handed out, how does one account for that?
Yeah.
Thank you.
Thank you very much, Nisha. I think that you've highlighted there some of the really difficult types of issues that we kind of need to grapple with as part of this. So really interesting. I think, Joanna, you wanted to come in to the conversation.
Yes, so I just wanted to say 2 things. Firstly, is to the last speaker and the point about record keeping and some of the environments in which international organisations work and their capacity to collect data. It seems nice and straightforward when you're sitting in other parts of the world, but it's not always as easy as it seems on the ground. And my main plea through all of this is to try and keep whatever solutions we come to as practical and as simple as possible.
Yeah, no, great, thank you.
The conversation earlier about having to hand the money back.
Yeah.
It is in all the contracts, and sometimes when the contract comes to an end, there are disallowables, as they're known, but they are very, very small element, and it's very rare for big chunks of money to go back to donors. So I think a simplifying assumption in that area that would say, nearly all the time, what you expect to happen is what happens, unless, as Pesh says, something extraordinary happens and you have to pull out or whatever. Again, to try and just keep it really simple, because judgments at minute levels of detail with data that's not very secure is just hiding to nothing.
Yeah, no, absolutely. Thank you for that, Jenna. Really, really helpful. I see Monica's asked a question about grants over several years, and do you recognise the whole amount? And if you think you will spend it, or just what you are entitled to in each year. I think it very much depends on what it is and the nature of the agreement. If you've just been given an amount of cash, you control that cash, then you would recognise the revenue all at once. And I think that's what we hear gives rise to challenges for people, because the money might not be spent for many years to come. So great question that's come in there. A comment from Tejas, weighting of the issues will change per jurisdiction. So it might happen that the guidance will have to address all of the options on the poll, irrespective of the percentage of interest. Absolutely spot on, Tejas. We're running this webinar in different time zones, and I think we've had a different perspective based on the jurisdictions that have attended. So we absolutely can't ignore anything, but it is kind of useful to get a bit of a steer on the things that are of interest to people, so we can make sure that we don't overlook those. Comment here about the issue of scale and size of organisation. More local NPOs may focus on volunteers, whereas larger NPOs may focus on donations in kind. Yes, absolutely. I think that one of the messages that have come through loud and clear, both through these webinars and the outreach that we did on part one, is about the need for simplicity, and particularly making sure that for smaller organisations that we've got something that they can implement. But you're absolutely right. I think the types of issue are going to vary by the type of NPO and also by the size of it, and we kind of need to cater for all of those. We've got a question here on the treatment of an asset given to an NPO with a condition to use for a specific time and give it back. More clarity on the accounting treatment. Henry, I'm going to take from that that's something that you're concerned with, and I think we're flagging it. I think we do see that as an issue, and I think when we get to developing the draft guidance, we'll be looking to provide an answer to those questions, because at this point we haven't decided how we're going to move forward in resolving the issues. So this is very much about exploring them at this point in time. Question about do NPOs have an issue around expense of a stock in a limited time frame for donor grants? Is there a practice to expense when purchased rather than being used from the balance sheet? I haven't heard that specifically. It's been much more about the ability to value the inventory. So if you have any examples of that or know anyone who has, please do put them in touch with us, because we'd be keen to understand that. One of the questions that came up in a webinar earlier today was about the methodology for issuing inventory. So FIFO and weighted average are the methods that are allowed. But the point was made that if you have got stock that is time limited, you might actually prefer to issue it based on how soon the stock is going to expire, and that isn't specifically covered. So some really interesting things there for us to think about. Tejas, a question about how to handle the differences in reporting when the legal framework of a jurisdiction has specific requirement on recognition and disclosure, which may or may not be the same as suggested by the guidance. I mean, the guidance that we're looking to develop, we want to be internationally applicable and to be applied as widely as possible. But in adopting the guidance, that is going to be a decision for each jurisdiction, and how it does that is going to need to take account of the legal framework that's there. So I think that's something that will need to be reconciled as each jurisdiction looks at how it takes up the guidance that's there. Another question, hopefully Tejas, that answered the question you raised. So for your organisation Concern Worldwide, we expense stock on purchase rather than carrying it on balance sheet. And that allows us to charge large donors within grant deadlines. Larger donors expect it, and generally we have to provide stock reports at the end. That is really useful. If we can follow up with you on that, Shane, that would be great. I'd like to know a bit more about that example. So thank you very much for raising it. I think, Pesh, you created a great segue into sort of a bit of a Q&A on at this point, just to kind of check in with everybody about whether they've got any thoughts or questions, or any thoughts about the alternatives preferred in the poll and the reasons for this. Again, I haven't been able to keep an eye on the chat, but I don't know whether there's particular individuals who'd like to come in based on comments in the chat. And Sam, whether you would like to tee up that for me?
Well, I wanted to ask my own question before I tee up anybody else's. But obviously my experience is mostly in Africa, and I've seen many organisations that use the deferral approach for grants with restrictions, even if they don't have conditions. And it's a common interpretation of IAS 20 in the not-for-profit space. So I just wanted to know, are there, or to clarify, are there any of the options or the alternatives that are being presented that include deferral of grants that have restrictions rather than conditions?
So I'm going to probably hedge my bets a little bit with IAS 20, but with all of those, the grant is given for a specific purpose. So something that's given for a restriction means that you can, so if the restriction is that you can spend it on education, you can spend it on anything in education. And I would not expect that you would defer at that point. And so government grants are normally given for a purpose that means that there is a condition to be satisfied, or you're entitled to the revenue straight away because you can use it and spend it on anything, and you've got the grant, and so you've got control of the cash. So I don't think under any of them there is a real, and I would want to double check that there are no examples that aren't immediately coming to mind, but I would not expect that revenue that has been provided where there's a restriction should be deferred.
Thank you. So then I just want to open the floor. There's a couple of people who've put comments in the chat. David again, Joanna, Ivor. If anyone would like to come in, please raise your hand.
David, would you like to kick us off again? You can unmute yourself.
Yeah, yes, that's fine. So I was trying to work out how to do the hand thing. Look, I think I've mentioned sort of before, we've just implemented IFRS 15 for not-for-profits. And it is hard trying to work out what this performance obligation is. So under the IFRS 15 standard, the broad approach is to recognise revenue as you provide goods and services to customers. Now that can be the person who gave you the money, or we've expanded the concept of customer to do things that the grantor who gave you the money requires you to do. So if it's to give money to third parties and do things for third parties, then that's meeting the requirements of the standard. But to try and work out what a performance obligation is, it's very hard. You know, examples, you've got $1 million, provide mental health services. That's it. So essentially under our requirements on what is sufficiently specific, you can't work out what the goods and services you actually have to provide in sufficient detail. So if you've got a number of counselling sessions, then that's sufficiently specific, but usually it's not. So that ends up as, you don't have a sufficiently specific performance obligation. You don't get to recognise the liability. You have to recognise the revenue up front, which doesn't gel with people's common sense that it should be matched with the expenses, which is providing the services. Yeah. So, and I'm not involved with conditions and restrictions. They confuse me. But I thought that the International Public Sector Accounting Standards Board, on their present obligation and looking to, if you've got this specified project or allowable expenditure, even if it's for yourself, and if you meet the criteria, then you recognise a liability until you actually essentially spend the money. So it's spending the money is the obligation rather than trying to work out the specific goods or service. So I looking at where the ISB is going, sorry, the IPS ASB is going. Yeah. If they sort of, but you did mention capital grants. Now, my comment back on those proposals were, well, if you've got a performance obligation to use that building in a certain way, does that mean you've got a performance obligation or a present obligation under their proposals, and then you get to recognise revenue over time rather than over the construction period? Yeah. So that there's gaps in what they're proposing.
Yeah, and I think it's fair to say that with the IPS proposals, you know, they were a set of tasks, which there were many comments, and they're considering that at the moment. So it's useful to know that they're thinking about these things, but we don't have any concrete proposals from them as yet. And they may very well be trying to address the questions that you've asked. But I think in many ways you've come back to kind of that timing, that matching concern that we saw raised earlier on in terms of how this works through. Sam mentioned Ivar as having a comment that we could bring in, and then I'll bring
Joanna's just raised her hand. Joanna, do you want to come in first?
Yeah. You're on mute, Joanna.
Okay, all right. So yes, just to build a bit on what David said, is that it's in his example, even if you knew that it was 1,000 consulting hours in terms of mental health, you don't have the costing system to tell you how much a consulting hour costs, and therefore how to recognise it. So you do, at a practical level, then come back to saying, well, we've spent the money, we've got people on the ground, they have been seeing people, and therefore it's probably reasonable to assume that we've met the condition, however badly defined it was, and therefore you come back to expenditure being the best proxy for working out how you're doing against each of those contracts. And the risk with that, of course, is that you end up recognising income that you're not entitled to, because it turns out that actually you've made all these assumptions, potentially, about the fact that there are people on the ground and they're providing mental health consultations that turn out, once you finish the grant and done all your reporting and it's been audited, that maybe you didn't provide 1,000, maybe you only provided 900, and arguments, and therefore some money needed to go back to the donor. So the risk is that you are over-recognising income by using proxy, by using expenditure as your proxy.
Yeah.
And then you can look and say, well, for this organisation, their disallowables are like this. They're tiny. They're 0.5% of their grant portfolio. They might be running at $200,000 a year, whatever the number is. So, and that's a cost to unrestricted at that point. But to build a whole process around trying to understand what these performance obligations are, when donors are not clear about them, when practitioners are not necessarily clear about them, and the information provision, getting information about it is really hard. Being able to simplify it all down to say, actually, we've spent the money in line with the contract, and therefore we've met our obligations, and if we haven't, we'll sort it out afterwards.
Yeah. No, yeah, I mean, I get it. There are some real challenges in getting the information that is needed, and there are also challenges, as you say, about being specific enough in the agreements that everyone understands what's required out of that.
The risk in all of this is about over-recognising income, and that cost of over-recognising income is not in your restricted bit of your SOFA, but it's in your unrestricted.
Yeah.
So running a level of disallowables provision against your grant portfolio at a summary level, much simpler for everyone whose job it is to implement on the ground.
Yeah.
You know.
Yeah, and you know, these are some of the things that would be good to get feedback on, about trading off kind of some of the pragmatics with the conceptual in here, and you know, that's going to be a tricky path for us to negotiate, but it's important for us to understand the significance of those so we can actually understand where the most sensitive points are. So thank you for that. That's really helpful. Ivar, do you want to come in? Not sure if you've unmuted yourself. We can't see.
Ivar Kunaka, do you want to come in? Can you unmute yourself?
Aha.
Yes.
Excellent.
Much better. Well, thank you so much. My name is Ivor, and I'm a financial management expert in grant management for CSOs in Africa. And basically, from all the conversations and the discussions, the presentations, I've managed to pick something very interesting here. And I realized that there is some contextual issues that we have to also look at, the different levels at which these NPOs are classified, and some of the things that actually affect them quite different and unique one from the other. Just like you find in Africa, we've got international NGOs, we've got national NGOs, then we also have community-based organizations, which are actually, perhaps this is the biggest pool of NPOs. These are the organizations that are at grassroots level. So you find that some of the things that we're discussing here might affect them, some of the things might not even affect them at all. But one of the things that we managed to sort out maybe for the past 5, 6, 7 years is that we managed to separate grant management from institutional accounting, which I was just talking to Sam on, chatting Sam on the side, and he was saying that no, there are different laws for that in the UK, but we don't have those kind of restrictions that you might have there in Africa.
Yeah.
And for that reason, some of the problems have already been solved just by separating the two. Whereas, I'll give an example, especially when it comes to classifying the incomes and so on. So the institution in itself is where probably you have your income and expenditure kind of accounting, where you have your income, expenditure, and your balance sheet, where you actually get to record even all the assets of the organization, especially those that are donated to the organization, probably at the end of a project. So the collaboration between, or the cooperation agreement between the institution and the funder would bring to life a project which is separate from the institution. And there you might use perhaps, this is where you find your restricted funding, grants that come, that are restricted maybe to a certain contracts, to budget lines and to timelines. So separating these two, I think it solved a lot of the problems that we might be having now, using payments and receipts and payments on one side of grant management, then income and expenditure for the institutional account, which are audited separately. Yes. So you'd be treating like maybe the grants, the grants or the projects, would be treating them like something that is like a project that is being run by the institution as a service, to maybe perhaps in collaboration with the funder to achieve whatever goals that needs to be achieved. So you find that every the issue of assets, even the re-evaluation or valuation of assets, which is done probably at the end when you're winding up the project itself, and the auditor verifying that, and then whether a decision is made to donate it now to the institution with the value stated and so on, then disclosure to that. That's how we solve some of these problems.
Yeah.
So we're talking on the side about the harmonization, the problems that might come with harmonization or consolidating the grants and the institutional accounts.
Ivor, thank you very much for sharing those experiences, and I think it would be useful, already talking to Sam, but to have some follow-up conversations around that. It'd be really useful to hear that. Thank you very much.
But I think from my point of view, the comments and issues that you all raised are very relevant. I work with the Australian Red Cross. I think there's a balance that's needed between trying to get the accounting perfect and transparent, the practicality, and actually the usefulness, because we could spend a lot of resources trying to get volunteer, because we've looked into this as well, so a lot of resources trying to get volunteering data and hours and into financial accounts, but how much value does that really add when the value of a volunteer might actually be, less loneliness or social connection for that volunteer as opposed to a financial dollar, or it might be opening up skills, abilities that enable that person to get a job. So they're quite intangible, non-financial benefits to in that example, and there's probably, and there's many. So I think, so I was the person that put, I think there might be a better solution, which is outside of the financial statement. So like complementary qualitative information, as opposed to trying to get the accounting perfect. So I think if we think about who uses our statements, financial statements, people are generally more interested in the stories and the message than understanding whether we've captured, all of the inventory that people donate or not. So I kind of really feel that we need to balance that look at it more qualitatively than quantitatively, and that's why I think there might be a better solution.
Yeah. Okay. So were you were the one who put forward the alternative? Is that what you were saying? Yeah.
I was saying I think there might be a different sort of, because all those 4 solutions are really not that different from each other. They're they've got subtle differences that try and address some of the issues, but I think the best solution might actually be something quite different, where you're looking at it from not just a qualified accountant point of view, but also bringing in some other, other ways of looking at information and data.
I mean, that's really interesting. So I think in alternative 4, where we're suggesting that there might be exemptions for certain things, and using kind of disclosure as a way of filling the gaps where there's no kind of accounting valuation on things, probably is the closest to that. But I think what you're suggesting is kind of there's a spectrum of that, and actually you think there might be a point that is kind of further away from the financial in alternative, in perhaps a variant on alternative 4.
And actually thinking about what users actually want. So are they more interested in getting that extra layer and level of financial information, or are we better getting not-for-profit or for-purpose organisations to put that resource into explaining better the social impact of the work that they do? And I kind of very strongly feel that second space is where we actually need to invest more of our time and resources into, because if we can't articulate the impact of what we do, then it's really hard to, convince funders or employees or volunteers why they should actually be doing this work to start with. And I think that's like a bigger gap than some of the financial issues that we're looking at here, which are worth exploring. But when you look at the cost benefit, that's where I think there's a complementary focus that's needed.
Yeah, and do you think that varies with the size of MPO?
Well, I think it could, in that if it's a larger MPO, like Australian Red Cross runs over 400 programs, so it's actually really difficult to articulate, all of those impacts because they can be so different. So when it's a smaller MPO, it might be easier because there might be one focus. Yeah. So if it's a one-focused organisation, whether it's big or small, I think that's possibly easier. But I think it's something across the industry that we can all do better.
Great. Thank you very much for that. Hi.
Yes, wait. I have to open my video. Regarding the general fund and special fund that you presented earlier, will it still be consistent with the fund also given by the American standard? Still consistent with that. For example, when you talk about special fund, will there be part of the special fund wherein you can use it also to other specific entity for a special purpose, for example? Because when you talk about general fund, you can use it for any purpose. But for special funds, really for this only particular project by itself, would there still be, is that consistent with the American standard regarding fund? I'm talking about general fund and special fund only.
Breaking up slightly, but I think if I've understood your first question, it's about why we're not looking at the US gap, why we're not looking at FASB. Is that correct? Is that your question? So the principle that we're adopting and is set out in part 1 of the consultation paper is to start with international standards as the start point for this. And not because that has been through a global due process that has given everyone the opportunity to kind of input to those international standards. If we picked the standards in any one jurisdiction, that wouldn't be true. And so we're starting with international standards, but I think, as we've said, we will look to access national standards. So to the extent that the US, Canada, Australia, New Zealand, UK have got their own national standards for non-profit entities, that we will look to that. So there'll be elements of the American gap that will potentially feed into this, but we want to start with international standards because of their accepted international basis. Does that explain? Yeah. Cool. Excellent. I missed the second part of your question.
May I make a question here? Regarding, so can you hear me on that?
Yes, I can. Yes, I can.
Yeah. Regarding the purpose of the fund.
Special purpose fund.
It's really for a special fund, right? So.
Yeah. So again, this project is focused on general purpose financial reports and statements, those that are generally applicable rather than special purpose financial statements. So so we're not looking at that. If you think that there are types of non-profit entity that have got specific requirements, it would be good to hear about those, and perhaps you can either put something in the chat or email us afterwards. But we are keeping to general purpose financial reports as part of this project.
Yeah, so that depends also on the donors, right? How about the Board of Trustees? The moment that they have to set aside some special fund, the Board of Trustees. So if ever they set aside the fund.
I'd like to park that. So we've got another, or I deal with that offline. We've got another webinar coming up talking about financial statements presentation, which will talk about reserves. So we'll be looking at that particular issue as part of that topic. If you're not able to attend that webinar, if you just drop us a question and we'll follow that up separately.
Hello.
Hi, Gareth.
Hello. Thank you very much for this event. Very interesting and useful. I'm being a little bit provocative, but I've raised the question. Surely, if we start from the IFRS for SMEs, all the problems around fair value will still be projected onto non-profits. And as we know, there's a huge argument that the whole notion of fair value is really specific to the commercial environment and can't really be used that meaningfully in a non-profit context. You want to comment on that?
So in some ways I would put it the other way round, in that I think there's lots of fair value stuff, particularly around financial assets and liabilities in the for-profit sector. That's commonly where it's talked about. But in the public sector, where I've got an extensive background, fair value is used pretty extensively in valuing all kinds of assets, including property, plant and equipment. So the concept of fair value is used quite broadly in organisations in the public sector that again don't have that profit motive. But it does raise questions about how fair value is determined. Because the IFRS 13 is looking at the highest and best use price for things, but when you're looking at fair value in entities that aren't driven by an exit price, there's other things that need to be taken into account. So I think when we're looking at fair value in the context of organisations that don't operate for profit, I think we need different guidance to support the generation of those fair values. I don't think that it's less relevant, but it certainly needs to be looked at in a different way and to help people prepare those.
Great, then both Shane and Fernando have made comments in the chat. I don't know if either of you'd like to put up your hand or unmute and share your thoughts. Or if you're feeling very shy, you prefer to stay in the chat, that's also okay.
Yeah.
Maybe you can you see in the chat, Karen? Maybe
I've got Fernando's question in front of me. He may have come in last, so apologies, but I'll just pick up on that. I mean, there's been a lot of discussion about whether IFRS and IFRS for SMEs should be the right start point for non-profit guidance, because it's generated from for-profits. And if in part one to the consultation paper, we've done quite a bit of analysis around this to kind of look at the pros and cons of the different international frameworks. And I think we recognise that there are clearly issues with IFRS for SMEs. It does not provide a complete solution, but it has lots of advantages for non-profit organisations in being easier to take on board because of the size of the standard and the way in which it's updated. But I think, as I set out in the hybrid model, it clearly isn't an answer on its own. The other point that I would make as well around that is in the public sector realm, where standards have been and are being developed, the principle that they adopt is to follow IFRS as much as they can and only move away from it where there is a sector specific kind of requirement that drives a specific need. And so a lot of the IFRS guidance is captured in Ifrs standards. And I think that may well be true of non-profit organisations. Whilst there are a number of things that are specific to non-profits that need to be dealt with, there's also a lot of things that are in common as well. And so using some of the stuff that is in IFRS and IFRS for SMEs may be completely appropriate to do, because that guidance is relevant, but completely acknowledge that it doesn't cover everything that is needed for NPOs, and in some cases it isn't relevant. And that's why we're doing this project, and also we're looking at an approach that doesn't rely just on one of those frameworks. I hope that goes some way to answering your question, but you know, this is something where we're really interested to get people's views on, and encouraging responses as part one of the consultation paper. And I should make a plug for that, because part one of the consultation paper, the consultation period finishes on the 30th of July, so that's coming up fairly shortly. So if you've got views on this and how this fits together, please do use that as a mechanism to kind of share those views. But I don't think there's a silver bullet here. So I think it's about how can we kind of make maximize the benefit of what is available.
Can I come back on the point I was raising about fair value? I mean, do you anticipate that IFR for NPO standard will require all this stuff about discounting of multi-year obligations under fair value, because that's what's caused horrendous problems for NPOs in many places? And I appreciate there's all the argument about whether it's material or not, but often people do seem to conclude that it is just about material, and you've got a 3-year grant and you end up with a horrendous discounting calculation that nobody who's reading the financial statements then really understands.
Yeah, obviously kind of the time value of money point is one that does come up, and I'd be really interested to get the example that you have and share that with us, because we want to come up with some guidance that's pragmatic, and we can simplify it as much as possible. So if there are specific issues like that we can look at as we are building the guidance, we'd very much like to do that. Okay, so I missed a question. Who did I miss a question from? From Shane. So if we start from IFRS, does that open up the issue of being at the mercy of the ISB changes, which may or may not take NPO accounts needs into account? Clearly we're talking about IFRS for SMEs as the start point here, and that is a standard that only gets updated periodically, typically I think every 5 years, so it's not changing all of the time. And as IFRS for SMEs is updated, we would lead to input to that process. But we can also, if we felt that IFRS for SMEs was moving away from what an NPO needs, we would want to kind of update the NPO specific part of the guidance to make sure that we don't unintentionally go on a track that we don't intend to be on. Thoughts on what's there, and particularly around the alternatives. David, you have your hand up.
Okay, sorry, I'm just getting the unmute right. I think that there are two areas that I've sort of looked at. One is Australia uses IFRS, which is essentially IFRS for SMEs, particularly for this one. So we've essentially got like 2 or 3 paragraphs that are different for not-for-profits. It essentially says, you know, don't worry about net realisable value for inventory because you're not holding it for sale. Sometimes it's for distribution and gifting and things. So sort of essentially use it like replacement cost. So there's no sort of service potential. It's sort of linked in, but I think it's worded more replacement cost, which makes it easier. And the other one is the donated item. So there's not a lot of not-for-profits that have inventory that I see, that they're holding it for sale or distribution, but it does cause a problem. I'll use the Salvation Army. I don't know what their accounting is, but let's use it because most people can relate to it. They've got these opportunity shops where you can go in and buy things. So we've essentially given a practical expedient to essentially look at the materiality and like have a low value exemption. So if you don't want to, you don't have to. Essentially value donated items, but some organisations do. I can't remember which one it was, but they wanted to, and they're allowed to if they can sort of work out some sort of reliable measurement to it. So I think it works because most organisations that are dealing with thousands of items just don't have the systems. It's not needed. You've got fairly quick turnaround, or should have fairly quick turnaround. So, from one year to the next, it's, do you really need to get an accurate inventory?
Yeah. No.
So
thanks, David. I saw that Joanna's put her camera on. Did you want to respond to that?
Okay, so if I could just reinforce that, because the valuing donated stock to shops, if that became a requirement for lots of charity shops in the UK, and I realise for some people this is a UK question, that that's a lot of systems for really not much benefit. And even if you were able to record the items, what value they then gave each item, well, you don't know the value to you and sell it. So you then go back, well, it's probably the best value when it's given to you is nothing.
Yeah.
If it doesn't cost you anything, if the value is nil, then that's your value. You're not, you don't have to do anything because it's nil. So and that would be a really serious overhead on charity shops if any attempt was made to try and value the donated stock.
Yeah. No, thank you for reinforcing that point. And I think we certainly see that as an issue and recognise that.
Karen, I guess with some of the sort of very evolving concerns around climate, some of the cost of wastage and removing inventory, so donated clothes that can't be sold, for example, is actually more than the value of the stock themselves, and then also brings that carbon footprint as a result of getting rid of that stock. So it's just, I guess it's not really a question, it's just a voicing out loud a concern where we might be putting value onto something that actually is not a value, it's a liability.
That's a really interesting point. I think as we did the outreach on part 1 of the consultation paper, particularly when we were talking about narrative reporting, sustainability and climate change came up as part of that. And increasingly, I think in day-to-day, I think people are starting to think about those climate impacts on like the financial reporting side of things as well. So a really relevant point to make, and I think something that we'll need to consider, whether there is a climate perspective that we need to put on this that might feed into how we look at some of these items going forward. So yeah, that's a really interesting point. I'm sure it's going to come up in a number of different guises, so good to put it front of mind. Yeah. Any other points anyone wants to make on this? I think one there was somebody who was preferring IFRS for SMEs, particularly interested in whether there was sort of a really important reason for that anyone's prepared to share. And any observations on the poll responses as well, in terms of whether...
Karen, I know Mark wanted to come in. He mentioned something in the chat.
I haven't...
Mark, do you want to come in and then maybe...
Sure, it's basically, to be honest, the main issue I've had with inventory has been slightly different from this, which is that, especially when dealing with perishable goods, and I'm thinking food or medical supplies, a big problem has been that using first in, first out, or weighted average, or whatever, doesn't really bear much reality sometimes to when goods need to be used.
Right.
And whether it's possible to get in something like first expired, first out, to encourage people to use goods more sensibly.
Yeah.
Whether that I think would be a really big help. Whether that's a practical option or whether I'm just putting too much into this project, I don't know.
No, it's a really good point. I think we did make the point there that, you know, sometimes donations are made of things that are close to expiry date, and if you got donations from two different peoples on successive dates, but one was closer to the expiry date than the other, then from a practical point of view, you want to distribute the one that's closest to expiry date first. So I completely get that. That's a really good point. Oh, thank you for raising that. That's really good.
Thanks.
Thank you. Ram, did you want to come in?
Yeah, thanks. I was the culprit who put up alternative one. For me, yeah, it was a close call between 2 and 1. And I was thinking about donated goods. And I was thinking about current replacement cost for donated goods. And I couldn't quite get my head around how you do that. So that's the reason I plonked on alternative 1. But I mean, it's not always the case that inventory is donated. Quite often it can be purchased. So current replacement cost may very well be the better option. So as I said, I wasn't quite sure about whether I was going to go for 2 or 1, and I ended up choosing 1, but clearly there's a strong preference for 2.
Yeah, I think you raise a good point, and I think that may be where there is the current replacement cost and service potential debate comes in, because if you're an NPO that's relying on donated inventory to deliver your service, if for any reason, you know, that got written off because there was a flood or a fire or something, and you needed to replace that, you still got to deliver your service to it, and so you still need that inventory to do that. And so it would be interesting as we work through the technical side of this, thinking about, well, what does current replacement costs mean in that regard. And, you know, because clearly there is a loss of service potential, and that's what might make you know, alternative 3 more attractive, because that's potentially more directly meaningful for an NPO. But yeah, so those valuations are going to be really important as we work these through.